Hello, trade pros, and hello, YouTube. I hope everyone's having an amazing day. And in today's video, what we're going to be talking about and discussing is the top 3 options strategies for beginners, right? These are option strategies that everyone should know. And I think it's a great place for beginners to start, at least to understand what said strategies are. So we're going to be going through the top 3, some directional, some not directional. You guys are going to learn a bunch if you don't already know about these. Now we're going to break them down with examples, and we're going to show you guys here on the screen how they may be played out. So I hope you guys are super excited and interested in what we have to say, and welcome to our channel. I want you guys to go to community.tradeproacademy.com if you want to join a free Discord community where we can chat together. We can set up trade ideas like we do on a daily basis for futures and options both. I also want you guys to smash that like button and hit that subscribe button if you're not already subscribed to our channel. So thank you guys so much. And we are nearing a pretty big milestone in our YouTube channel, and I hope you guys are there to support us through it. So let's get excited for this intro and jump right into this. So here on my screen, we've got these intraday charts. To start this video, we will break down the 3 main strategies and what they are called. Now I'm going to write them down here so it's a lot easier for us to understand them. We're going to use these charts here that you can see in front of you as guides mainly. So let's take a look at some of these, right? We got NVIDIA, we've got Apple right here, the main ones on the screen. Now, the 3 strategies that we have broken down are going to be, right? Number 1, it's going to be directional, super directional. So what we're going to talk about is, we'll just write directional here. And we're going to be talking about long calls, right? And long puts. So this is the first strategy that every beginner should know. Now, the second strategy is somewhat directional, not entirely directional as this one right here. So we're going to just write directional, right? And this is what we call a debit spread, right? A debit spread. So we're going to talk about the debit spread and the 2 legs to the debit spread. And then the third one here is going to be non-directional. Now, this is going to be the most complicated out of all of them, especially for a beginner, but it's called the credit spread, right? So these 3 main strategies are going to be the cornerstone for a lot of different options trades and options strategies, right? Options ideas. So this is going to be the most common, number 1. It's by far the most common. It's the one that I practice the most. This one I take from time to time, not very often, but this one pretty much every day. And then this one, not really, very, very rarely. And we'll talk about why, right? What certain conditions have to be met. Now, certain conditions have to be met for 1, 2, and 3, right? But for 3, I think the conditions need to be a lot sterner for the most part. So why don't we dive into these, and we'll go with number 1, right? We're going to talk about what is the directional long call, right? And long put, right? Either or. So as we know, a long call is a call option is something that we buy in anticipation that the price is going to go up. It is a contract that we buy, right? If we are long, we're going to buy this contract in the anticipation that the underlying asset that we choose goes up, right? We're going to purchase it for a certain premium, right? Whether it's $100, $1,000, whatever it may be, right? Now, the long put is purchasing a contract, a put contract, which anticipates that the price actually falls down, right? And again, they can be purchased for X amount of premium, right? Let's say $1,000, $100, whatever it may be, right? So this anticipates that we go up, and this anticipates that we go down, right? And you buy these contracts. This is very similar as to owning the stock, except naturally you have leverage with the Greeks and all that. You can find other videos that we talk about that stuff. We have another mini course for the options coming out that'll explain a lot of that. And obviously, this is very similar to actually shorting the stock, but again, on a leverage scale. So the long call and long put, right? We can day trade them. We can swing trade them. We can do whatever we want with them. But the idea is we purchase a contract, right, for X amount of premium with the anticipation that the stock goes up. So what do we do with these contracts? So for example, we go long call, right? We want to go long calls on Apple here. Apple, AAPL, sorry. Apple here. And 1, we have an expiry. And 2, we have the strike price, right? So the expiry is when the options expire, whether it's on a weekly basis, because Apple has weekly call and put options that expire every Friday of the week. On a monthly basis, every third Friday of the month, I believe, is the monthly expiry. A quarterly basis, an annual basis, whatever it may be, right? You can buy a contract that expires in X amount of time. Now, naturally, the closer date of the contract is, the more volatile it's going to be, the more of a move you need in your direction. Otherwise, the contract will lose value. Now, the premium, right? The premium is something that gains or loses value, right? So if the stock moves against you, the premium in this case will drop, right? The premium that you have put in will start dropping. Now, the max loss in the long call or the long put is whatever the premium that you put into it is, right? So whether that's $1,000, $100, that's the max loss. Now, we obviously would prefer that people use stop losses for sure. And the max gain is technically going to be infinite in terms of the rise between now and the expiration of the contract. So if you get a contract for like 2 years, for example, on Apple, and in 2 years, if Apple is $300 again, right? Remember those pre-split times, then this contract's going to gain a lot of value, and you can sell it for a higher value than you bought it, right? Again, to the put side, if we talk about long puts, the max loss is going to be the premium, and the max gain is going to be whatever the price is down to zero, because a stock can only drop down to zero, right? Now, there are other criteria, right? Like the Greeks that we have to consider, right? You can use options calculators. They're all over the internet. We have to consider IV, right? We have to consider the expiration as well. There's a lot to consider in terms of calculating the profit and loss of the option and its potential. Now, the strike price is going to be the anticipated price by the expiration that you think that this call is going to be. So, for example, let's say the expiry is this week, right? December 10th. It's currently the 7th. Right? And I'm going to choose a strike on Apple for 175. That means by this date, I anticipate that Apple is going to be worth this much. It's going to be 175. Now, the caveat here, the break-even point is going to be the strike plus, right, whatever the premium is. And the premium is usually denoted in a dollar amount. So it's going to be $1, right? Because there is 100 contracts in 100 shares in each contract, right? That is the leverage that you are given necessarily. So you simply multiply whatever the premium cost is by 100. So assuming it's $1, right? My break even plus $1. That means that if I'm going to make any money, Apple has to be at least 176 by the expiry. Now, the thing with this is I can make money, right, before the actual expiration, right? As long as Apple increases in price. Think of it this way. So if the value of something increases, right, you're willing to pay more for it. So the closer we get to 175, right now, let's say we bought it before the close at 170, right? The closer we get to 175, the closer at the money or in the money this option is going to be. That means that someone is willing to pay more than $1, right? If this is $1, right, at 170, if Apple goes up to 173, right, this might be now worth $2 and or at least it would be like $3.50, whatever that would be. Because remember, here, this would have to be, right, it would have to be 176 to break even. So if it's at 173, right, we're assuming that the break even price continues to potentially rise. Right. So keep that in mind. Now, we go long calls and long puts when we're day trading, when we're swing trading. And we do this for longer term swings on the call side mainly, and like intraday puts personally. So I like to put, right, on an intraday basis and call both on an intraday basis and on a swing trade. Because typically, like names like Apple, unless you're in a turnaround bearish market, it's very hard to see them continuing the downside. It's a lot easier to see their momentum to the upside. So I like to do that. Now, if we understand both calls and puts, right, the second strategy is going to be the debit spread that we talked about. And remember, calls and puts, they're directional. They either go up or go down. Now, the debit spread consists, right, of either 2 calls or 2 puts. Now, this gets a little more complicated because it's a spread. That means we are buying one, right, or many calls or puts, let's say calls, and we are selling the same amount of calls. Now, how would this make sense, right? So remember, options have different expirations, right? They have different expirations, but they also, mainly for the debit spread, what's important is they have different strikes. So, for example, Apple has 170, 172.50, 175, 177.50, and so on, right? 180, whatever it is. So these are the strikes, for example, on Apple. Now, the idea with this directional / non-directional spread is that we are going to limit the actual premium that is costing for us to get into this trade. So traders typically use this when they're not 100% directional and they want to limit the premium used, right? So for example, if on Apple, if I was going long calls purely and I would go out the money, right, 175 calls. So with the debit spread, what I can do is I can go, you know what, 170 call, which is going to be more expensive. Let's say it's $3, right? That expires in 3 weeks. And then if I want to reduce this cost, and I'm not super directional, but I think it's going to be in between 170 and 175, then I can sell the 175 call for the same expiry for maybe like $1, right? Let's just assume I'm just making these numbers up. That means the difference is what I pay because I receive this as a credit when I'm a call seller, and this is going to be debited, right? So that means that my total price for the premium is going to be $2, right? Or $200 a contract. Remember, times 100. Now, in a short call, if I'm selling a call, the call gains value as long as the price is underneath, right? Now, the long call, the call gains value as long as the price continues to rise. So that means I have sandwiched, right? I have sandwiched my potential returns, right, between 175 and 170. So remember, my potential returns are going to be 5, right? The difference of this minus $2 because that's the net premium I paid. So that means my max gain is going to be capped at $300 a contract, should these be the circumstances. So I would use this in a slightly directional play, right? I would use this when I want to really cut the cost of something and I anticipate it going up, but it's just too expensive and too far out for me. So for example, if I'm trading something like Roku, right, and I want to buy weeks of time on Roku or Tesla, for example, they're going to be thousands of dollars, right? So with Tesla, if I want to do a debit spread, right, if I want to debit Tesla and I'm looking at a contract here, let me just look at it on my other screen. I'm looking at a contract on Tesla and I want to go December 23rd, which is in 16 days, right? Now, Tesla is currently trading here. We can take a look at it. Tesla is currently trading at 10.55, right? It's at 10.55 approximately after hours. So that means at 10.55 at the money, right? The strikes that are at 10.55, they're worth $55 a contract times 100. This is $5,000 and $5,500, right? A contract. So that's super expensive at the money, right? I don't want to be able to potentially lose this max premium. Number one, I'm going to go out the money naturally. In 3 weeks, maybe I think Tesla is going to be closer to 1,100 or even 1,200. So I'm going to say, you know what? I'm going to buy these 1,100 calls that are out the money, and they cost, right? They're pretty expensive. They're about $36 a contract or $3,600 a contract. Now, what I'm going to do is say, you know what? I don't think it's going to be above 1,200, right? This is even further out the money. And I'm going to sell this one. Now, if I sell the 1,200, I'm going to get about $12, right? I can sell something lower, obviously. I'm going to get about $1,200 on this, right? So the difference, I'm going to be paying $2,400, right? So it's It's still a lot, right? It's a lot less originally. I can sell a lower call, maybe 1150, right? But then that caps my potential gains. Now these are the gains at expiry. If Tesla rises another $30 tomorrow, this whole position would have gained the value and I can just get out of the position, right? I don't have to stay into it until expiry, and I don't have to wait until price gets above 1100, right? I can just use this to get cheaper directional moves, right? So just keep that in mind when you're trading these debit spreads. Now, finally, the third strategy that you beginners should know is going to be the credit spread, right? This is maybe by far the most difficult out of the beginner strategies, I would say, out of the three that we talked about. And it's a spread. It's a spread just like the other one that we talked about, but this spread involves more of a crediting. So what does that mean? So that means that, remember, we talked about a debit spread. And when you debit, that means the money actually you are paying it, right? In the options world, when you debit, you're paying it. So remember, you debit the long call that's closer, or long put, whatever you want to call it. And then you credit, right? That means you get the money in the account for something that's further out the money. So in this case, what we're doing is we're going to sell the closer out the money call or put, right? So C or P, and we're going to visualize this because it gets a little more complicated. And then we are going to buy, right, even further out the money. Let's go F OTM, call or put. Now you go call and put and put. In the debit spread, right, we call the debit spread with the calls a bull call spread, and the puts a bear put spread, right? In this case, right, if we're talking about credit spreads, we are talking about a bear call spread and a bull put spread. So let's break this down step by step. If we were to sell, right, let's just get rid of some of this stuff here. And let's talk about, for example, just something super easy, right? Let's talk about the SPY. So remember, if we were to sell a call, right, we would anticipate that the price is going to be less than whatever the strike is, right? Let's say 473 if we're looking to sell calls. If we sell calls, remember, when you sell calls, you want the price to be under the level or go down. If we buy calls, right, if we buy calls down here, the 465 calls, for example, if we buy them, we want price to go up, right? So just like the debit spread where we wanted to minimize, number one, the risk, and number two, the price, if you sell calls, technically your risk is unlimited, right? Because price can continuously go up. Now, if you sandwich this by buying a call above the area, your risk is limited to the difference here, right? To the difference minus whatever the credit that you got was. So that means that, let's say I sell a call at 475. Now the difference is going to be limited to $200 because it's a $2 difference here, right? Depending on how many contracts you have, whatever the case may be. So on the other hand, right, if we do the put side, right, remember, in this case, we don't want price to get within this area. We want price to stay under the short call. If we are doing the same thing to the put side, right, we have a put and it's going to be a short put. So we want price to stay above this level, and then we're going to buy a put to minimize the potential maximum risk here. If we buy a put, the potential loss is going to be the difference between these two minus whatever credit you've received. So for example, let's break this down. So let's use the put example, right? We're going to use the put example. So in this case, what we're going to do is, if I am selling the higher put, right, it's going to be an out the money put, right? The put's going to be under the price. So what I want in this case is I'm going to sell a put at, let's say, 450, right? When price, let's say price is here and we're selling the put at 450, and maybe, right, maybe we're selling this put for 2 weeks of expiry and we managed to get $1 out of it, right? So this dollar goes straight into our account, right? It's going to be credited because we're selling it to someone. We receive that premium. Now, if I buy a put, right? If I buy a put at let's say 448, right? And this put is going to cost me 50 cents, right? This put is going to cost me 50 cents. So the fact that this put cost me 50 cents and I'm getting $1, that means that net, I'm going to receive $50 a contract or 50 cents, right? The difference. Now, my max loss is going to be, right, $2 difference minus whatever I've already received. So that means $150 per contract. Now, usually when you're selling credits, the max loss is going to be greater than the max return, but the idea is the probability is going to account for that. So the thing is, these are not directional because you just need price to expire above this level to collect the max premium. So you need price to expire to collect that max premium, or this premium to just go to zero. And a way for that to happen, for the premium to go to zero, is that price just explodes, right? It just explodes away from that put or away from that call, right? And then it's going to be most likely zero because the return potential for it into that same area by expiry becomes very minimal. So keep that in mind with credits. Now, one caveat for credits, right? Remember, this is more of a beginner lesson. We can't cover exactly everything, but one caveat for credits is that you do not want to trade higher IV stocks, right? Even though IV, you're going to collect more premium, is because they move way more erratically for the most part. The idea is you want to trade a stagnant stock, right? And I'm going to show you one that you could extract premium out of on a consistent basis, one that either has a steady decline, a steady rise, or a steady sideways move. Viacom, symbol VIAC, has been just dead, right? Slowly just slumping lower. This is a stock that you may want to credit. It's not really going anywhere, and you can anticipate that it's going to continue slumping to the downside. So with that being said, right, those are going to be the three main beginner strategies that I would recommend all beginners know in the options world, right? So let's go over them. Again, the long call, right, and long put, which are directional moves, right? You buy these with premium. The max losses are going to be the premium, and the max gains are technically going to be somewhat infinite. Then you have the debit spread, which again is more directional, right? You are looking for a direction, but you're capping your gains and the premium that you pay because you're not that certain of a direction like you are with the long calls and long puts. Finally, right, the credit spread. This is going to be the non-directional move where you're looking for price just to not enter a certain area, whether it's upside or downside. So if you guys have learned a lot, I want you guys to smash that like button. And remember, these are just beginner concepts. There's a lot more to these than just this. If you want to learn more, just drop a comment down below and we'd be glad to make new videos for you. So I hope you guys learned something and enjoyed this. And I hope to see you guys next time here at TradeProAcademy.com. So smash that like button, smash that subscribe button. And if you want a video of how we can find good stocks to credit, debit, or just get long, let us know. So thank you guys for watching, and we'll see you guys next time.